We're talking about the future of Ethereum and crypto assets as an investment and what the merge means for not just stakers, miners, but also investors. Welcome to the show, David Shuttleworth, who is a DeFi economist at Consensys. David, it's your first time on Kitco. Welcome to the show.
Thanks for having me, David.
I want to talk about your work as a DeFi economist towards the end of the interview, because I think that's a very interesting job you have and very important research that you're doing. I'd like to congratulate you, of course, on the report that you published on the Ethereum merge. We'll be touching on several aspects of this report, including the fact that Ethereum is, in your words, ultra-sound money, and we'll define what that means. But first, let's back up and look at Ethereum, at the Ethereum merge from a 30,000-foot perspective, and then we'll drill down to the technical details on what happened, how successful it was, and what it means next for scalability, decentralization, and security. Ethereum merge, why did it need to happen? Probably a very obvious question for a lot of people who have followed the space, but let's just talk about that first. Why was this necessary?
I think just from kind of, at a very human level, I think that, getting Ethereum more energy efficient and kind of reducing its carbon footprint was kind of first and foremost. We see from the shift over to proof of stake that, there's different estimates out there, but let's say we reduced, emissions by 99%. So I think that, that's a tremendous win for everyone involved, not just, within kind of the Ethereum and Web3 ecosystem, but kind of every retail and every institutional, agent within the space. I think it's a big win. So I think first and foremost, that's kind of why it needed to happen. And secondly, I think kind of the shift over to proof of stake, it allows Ethereum to become a little bit more democratic, where you no longer need to have, huge capital or sort of huge overhead to kind of run and participate in the network. You can just kind of stake your assets and kind of participate in that way.
Okay.
So I think that go ahead.
No, sorry, I cut you off now. Go ahead.
Yeah, no worries. Just the democratization, I think, is something that was also super important, where now essentially anyone can participate in the network.
Mm-hmm. All right. Moving from the proof of work to the proof of stake platform. Now, the Ethereum merge, like you said, has decreased the carbon footprint. We're supposed to decrease the carbon footprint by 99.9% is some estimates that I've read. Can you explain this process, why the proof of work model that uses miners moving to the proof of stake model that uses validators, why this becomes more energy efficient?
Yeah, I mean, in general, in order to participate in any proof of work system, not just Ethereum, but Bitcoin and others, essentially you have to run, very technical hardware, miners. And in Ethereum's case, like you're running miners that use GPUs that do calculations. And those things cost, obviously energy. They take, human capital in terms of like having a very pronounced technical wherewithal to run them. They also take, in many cases, you have huge warehouses of mining equipment that run 24/7 and obviously consume vast amounts of electricity. When you shift over to proof of stake, essentially you go away from providing work to basically providing a financial bond, where it's kind of your bond is on the network to say that, these validators are running the correct transactions and they're doing them honestly. And if they are found to be, misbehaving or, acting maliciously, they can get slashed and kind of lose their financial bond. So I think like that overall is kind of the focus of the shift.
Okay. Let's talk about your work on ultrasound money. Can you define that for us? What does it mean to have an asset that is defined as ultrasound money?
Yeah, I mean, overall, like the name ultrasound money, like I'm not a huge fan of it, but I think like the general sense is
catchy,
kind of that. Yeah, I did not coin that, but yeah, I think overall the concept is generally around like you have an asset that kind of is stable and doesn't it's kind of expected of what it'll be, and over time in Ethereum's case it becomes at least in theory and I think in practice shortly. It becomes deflationary over time, where there's certain constraints placed on the supply, and it becomes scarce over time.
Okay, we will talk about the deflationary aspects of Ethereum in just a minute, but I want to go over this chapter in your report and just talk about financial assets in general. You wrote that the recovery cycle was led by monetary policy, as changes to fiscal measures such as taxation and government spending are often politically challenging to enact. Central bankers were able to act independently and therefore implemented easy money policy faster than fiscal policy makers. In addition, they were emboldened to continue the accommodative policies to help economies recover because real inflation remained low. And then you have a chart that highlighted the differences between financial asset prices and the real economy. And I think you were making the argument that monetary policy was a major, boost to asset prices throughout the pandemic. Is that fair to assume?
Yeah, originally it was, and as we've seen, in kind of recent macro headwinds, it has, monetary policy has kind of taken the opposite effect. And that's kind of what led us down this path where we are now, where I think you have there's no positive yield right now in the space. And I think that's kind of where Ethereum's, fitting within an asset class comes into play, where you have an asset that decreases, over time with usage. So the idea is that people use it more to transact. It operates as like a settlement layer. It has a high burn rate because of transactions, and that kind of offsets any net issuance. So you're left with an asset that over time decreases in terms of quantity.
Okay, are you surprised that just based on your chart, a lot of the financial asset classes outperformed real economy prices by a tremendous margin since 2009? Why do you think this happened?
I mean, it's tough to say. I would say it all comes back to kind of, we were in a space of almost free money, where rates were historically low. Anything from like a traditional bank loan to a mortgage, and people just had that sort of discretionary power to buy, and disposable income was quite high. So it kind of led to this cycle where, money was cheap and people could afford to buy things. And we've kind of seen that money is no longer cheap. Interest rates are way up. Mortgage rates over the last year are almost double. So your disposable income in every household is much lower than it was.
Right. And just looking at these financial assets and how they've appreciated over the last 2 years, notwithstanding the correction we've had since last December, do you think these asset prices appreciated at an appropriate pace given actual economic growth?
Yeah, another one tough to say. I would say, generally speaking, I think that everything was kind of priced a little bit high, and that's just not in the traditional macro. It's also kind of within Web3. We've seen a lot of very interesting startups in the space that had very promising appeal, but had extremely high valuations without even kind of launching an actual product. So I think we saw it throughout the spaces. Valuations were high across the board.
Okay, very good. All right, let's talk about Ethereum now and whether or not you think Ethereum's valuation is high across the board. We'll get to that at the end. But first, let's talk about the deflationary aspects of Ethereum. Now, I'm just going to read a paragraph from ethereum.org, and it will explain to the audience exactly how this works. POS, proof of stake, is supposed to dramatically reduce ETH issuance. After the merge, it says only the 1,600 ETHs per day will remain, dropping total new ETH issuance by 90%. Some call this triple halving, similar to the concept of Bitcoin's halving, except you're getting even more. Now, let's explain this process in layman terms. Why the net issuance drops? I know that the mainnet is, in theory, no longer supposed to provide any issuance at all. But why is the Beacon Chain net supposed to reduce issuance relative to the prior issuance numbers?
Yeah, I think it gets a little bit technical, but I think that like the key takeaway is that there's not going to be a specific number of issuance of net issuance under proof of stake. Right now, it's about like 600,000 ETH annualized.
Yeah.
But that kind of changes with the amount of participants, namely with the validators. Mm-hmm. But removing kind of the mining aspect and proof of work, where you have miners constantly mining and racing to produce blocks, where you shift over to something that's a little bit more stable and a little bit more preset, and just depends on kind of like participation rates within the network. I think that's largely responsible for kind of that shift in issuance.
So I'm just curious as to why the supply did not cap immediately after the merge happened on September 15th. So I'm just looking at Ultrasound Money, for example. It's a website, ultrasound.money is the website, and it actually tracks supply change since the merge. And since 12 days ago, ETHs actually grew by 8,000. So there were more than 8,000 ETHs put into circulation in the supply. You do see the graph, and I'll show that on the screen, of the supply growth kind of capping in the last 2 days. But in theory, the burn rate was supposed to equal the net issuance, the issuance rate, making net issuance zero on the day of the merge. Why didn't this happen?
Yeah, I think it goes back to kind of the mechanism in place which defines the deflationary aspect, and a lot of it has to do with network usage. There was a recent upgrade over the summer, EIP 1559, which implemented a burning mechanism. So in short, every transaction, a portion of the Ethereum is burnt. So in theory, as network activity increases, so does the aggregate sum of Ethereum burnt. And I think that in general, the burn rate has to outpace that issuance. And that's what makes it deflationary. So anytime, any given day that you have burn rate is greater than issuance, you're going to have a deflationary Ethereum. But when you don't, you will not have a deflationary Ethereum.
Yeah, well, like we discussed, so far it hasn't happened yet. What needs to trigger in order for the burn rate to be greater than the issuance rate?
Yeah, and that's a good question. I think a lot of it has to do not only with kind of the Web3 ecosystem, but also traditional macro. Like, as I mentioned before, disposable income is down, money is more expensive, people don't have it to spend, and that's retail and institution. So that also kind of drags down network activity, where you don't have people coming in and saying minting NFTs because they want to buy NFTs on a specific day. It's kind of, that activity is kind of dwindled down. So I think that, overall, as we see, stronger projects being built and more use cases, that will kind of facilitate more usage.
Are you saying that Ethereum's deflationary model ultimately is conditional on market forces?
Yeah, that's a part of it. It just depends on kind of, I would say it's more directly correlated with network activity. And, it's important, like network activity is always going to be impacted by kind of traditional macro. So when you see, kind of there's different, different definitions of recession, but overall, kind of when you have these headwinds, it definitely will impact overall activity. But in general, in activity, as activity increases on the Ethereum network, you will see kind of the burn rate kind of outpace the net issuance.
Does the gas fee actually influence the burn rate? Just quoting Ethereum.org, it says at an average gas price of at least 16 Gwei, at least 1,600 ETHs are burned every single day, which effectively brings net ETH inflation to zero or less post-merge. Again, this assumes that the gas fee will be at least 16 Gwei. Currently, we're at 23. I think a few days after the merge, it was significantly less than 16. I think a few days ago it was like 11 or 12 or 10. But I've noticed just on the supply curve that as soon as the gas fee spiked up to above 16, the supply growth rate started to peak. Was this a coincidence, or was there a factor here behind? Was there a correlation behind burn rate and gas?
Yeah, I'm not so sure. I think that, like, mathematically speaking, like if you take it any given time, like you can kind of make and reverse engineer that calculation. But I think, again, it has to do with network activity. You could also make the argument, if gas is super cheap, I might be more inclined to use Ethereum to do a transaction than like another network. So if I have the choice to mint something on Ethereum and it's 11 Gwei rather than say 30 Gwei or 40 Gwei, I might actually use Ethereum. So you can make the argument kind of in both ways, but I think the lower the gas fees, the more network activity you have.
Mm-hmm. All right. Do you have a projection as to roughly when we can see a supply cap? I'm not saying supply cap in the sense that Ethereum necessarily has to have a supply a maximum limit like Bitcoin is programmed to have. But in theory, if net issuance is supposed to drop to zero or negative, we should see a supply cap on Ethereum, right?
Yeah, it'll be more of like a theoretical cap, but my sense is like there's no way to kind of time it.
Right.
Again, it depends on activity, but I think that in the short term, at least, we're going to see cycles of Ethereum becoming inflationary and then going back to being deflationary and vice versa. I think you're going to have that in the short term. But again, I think that, as new projects, there's a lot of stuff being built in the bear, as they say. And I think a lot of those new projects and new use cases come about. You'll see an increase in network activity, but yeah, for the short term, I think we're going to go through cycles.
So increased network activity has to happen first, based on these projects that we're going to talk about before we get a deflationary Ethereum. All right, so let's talk about some of these new projects and the future of Ethereum. In your executive summary of the report that you helped co-author, you wrote that the total number of unique addresses of Ethereum has doubled to over 200 million over the last 2 years. Ethereum is now the world's largest programmable blockchain and is the foundation for the future of the internet, Web3. Those are very bold statements. I know competing projects that would argue that their project is probably more suitable for adoption in Web3, but what's your case for Ethereum?
Yeah, and let me preface that with saying that I am by no means an Ethereum maximalist. I am much a fan of kind of the multi-chain world. Yeah. But I think that in general, I think that in my view at least, I think that Ethereum it serves as that settlement layer. And I think in that report we detailed kind of the value of transactions settled versus Visa. Like overall, Ethereum settled more transactions than Visa, and in a year to year, over the last year to year from last year. But yeah, I think it's kind of one of those things where mass adoption with Ethereum, just because of sort of the security, the kind of value locked into it, it's going to be a driver of people actually using it to do business.
Okay, what kind of business? Give us some examples of practical applications. Yeah.
Yeah, I mean, look, I think in terms of DeFi, in my view at least, I think there were a lot of projects that didn't really do anything meaningful. It was just kind of like shifting out of people were just kind of looking for yield in a project, and once that yield was no longer there, they moved to another one. But at the end of the day, there's still super strong projects. Like I can name a bunch, but like you have Aave and Maker and Compound, and you have all these strong projects kind of within the DeFi space that allow you to do, say, decentralized borrowing. Like if I have extra assets on hand and I want to, earn some sort of return, I can do this in a super permissionless way by just lending my assets to someone, trustlessly, and getting return for it. So I think those sort of fundamental aspects of an economy, a lot of it's about lending and borrowing. You can do them all on the blockchain. And I think you can do them, without needing kind of that middleman to do it.
Mm-hmm. Okay, and do you think that the current macro conditions are conducive to more project building right now, or do you think that we need to get out of this recession or bear market in the stock markets before renewed interest comes into the crypto space? How correlated are these two spaces is basically my question.
I think it's a little bit of both, right? I think that the bear market kind of forces out the bad projects, like teams that were there just for one reason, and that one reason was just kind of like make money and get out of it. Where now you see a lot of folks in the space now are building through passion. Like you have a lot of passion projects, and at least in my view, those things turn out to be a little bit more robust than the opposite. But to your point about the overall macro conditions, like they need to kind of calm down before we see, almost mass adoption and mass inflow into the ecosystem. Yeah.
And are you at all concerned about the fact that the Federal Reserve is still raising interest rates, which increases borrowing costs, but also, in a sense, actually increases interest rates for banks, and now your deposits, well, in theory, accrue more interest, which in some sense is competing against staking in the DeFi ecosystem, is it not?
In a sense, it is. I think at the end of the day, you're kind of competing for disposable income, particularly from retail, and then you're going to compete for kind of real positive yield from institutions. So I think that, increasing interest rates, I think there is a silver lining for DeFi. And that particularly, with Ethereum, assuming that network transaction pace kind of heats up a little bit, I think you will see it start to become deflationary. And I think that when it does become deflationary, that's when you kind of see that becomes super attractive to institutions, where they know they can kind of become validators in some way, participate in professional staking services, but they can earn a real yield despite current inflation.
So you're saying, and you have a chapter on this, on why you think the impact of the merge on institutions is positive. So you're saying institutions can now earn a greater yield through staking, which incentivizes them to invest more in Ethereum. Is that the summary?
Yeah, and again, it goes back to it becoming deflationary, because the idea is that over time Ethereum becomes a little bit scarce, right? And I think that is super attractive. That if I'm an institution, I'm looking for somewhere safe to kind of park my investment. I know that if I'm a believer in kind of Web3, and I'm a believer in kind of Ethereum as like the de facto settlement layer, that's a kind of a safe bet to make, to kind of park my investment within Ethereum if I know that activity picks up and kind of deflationary mechanisms kick in.
One could argue that with a scarcer supply down the line and more institutional concentration, Ethereum becomes less decentralized. How would you respond to that?
Yeah, I tend to agree with that. I think that in this aspect, I don't think it's it is centralization, but I don't think it's kind of malicious centralization. And what I mean is that previously under proof of work, you're kind of relegated to like a mining pool. Like you could point your finger at, say, 4 large mining pools that were responsible for the bulk of network transactions. And now we see institutions like Coinbase and Kraken and Binance and decentralized Lido come into space and operate, say, 55% of all staked ETH. But at the end of the day, previously under proof of work, if I want to do a transaction on the network and I didn't agree with some of the mining pools, there was nothing I could really do about it because they're responsible for the network. Now at least I have a say, and it's more democratic in that if I stake my Ethereum with any of the with Coinbase, and there's something that they do that I don't like, I can unstake. So it gives kind of the individual a little bit more autonomy, and then they can decide who validates the network. And if it becomes a thing where any of those, and not to call out Coinbase, but if any of those entities that have that chunk of staked Ethereum, if it's seen as problematic or malicious at any point, we can unstake. So I think it gives a little bit more power and autonomy into the individual, whereas within proof of work, you didn't really have that.
One more piece of criticism, just to play devil's advocate. Now, one could argue that the road to hell is paved with good intentions, so maybe it's not malicious centralization, but perhaps down the line, some whales or institutional investors decide they don't want Ethereum anymore, and if they liquidate en masse, that could have huge dramatic implications for traders and investors in the short term. Could they not?
Yeah, in terms of price, but in terms of network integrity, like if one of those entities were to say unstake and sell all of their Ethereum at once, just hypothetically speaking, that would impact price. But it wouldn't impact the network per se. You'd still have a network of validators that validate transactions, and you'd have people quickly. Because right now, the way, without getting too technical, right now the way it works is to become a validator. Like those spots are kind of limited. You can't just there's like almost a waiting list for it, so to say. But if you have large institutions kind of unstake and get out of that network, I think you'd have kind of a mass inflow of willing and able entities ready to come in and take that up.
Well, first of all, I don't mind if you get too technical. It's okay. But second, I've always been curious how you qualify, how one qualifies to become a validator.
I think, and I'm not a validator myself, but I think like at the end of the day, the bare minimum requirement is that you have, the 32 ETH. And anyone who has that can potentially become a validator. And from there, there's, I think the Ethereum Foundation does a really good job of posting the documentation of like setting up a validator, what it takes. But essentially, as long as you're online, as long as kind of you're performing, you're not going offline, you're not doing, malicious behavior, you have the 32 Ethereum, you can qualify to become in that pool of validators.
But are there checks in place to I guess, ensure that validators are more or less decentralized around the ecosystem, and we're not just having, a few entities control the entire chain?
No, there's no, I mean, again, if you have, if all the people who have that 32 Ethereum happen to be based in, one part of the region or happen to be kind of, confined in one specific subset, like that's kind of what it is. But again, if that becomes problematic, you can always unstake.
Okay.
Or, the other thing too is just quickly touch upon is that like, if they do become, malicious or doing things that aren't honest, they do get slashed and they lose a significant amount of their assets.
Okay. I want to spend a minute talking about sharding now. It's in theory supposed to be the next step in the ETH evolution. It's supposed to, moving from proof of work to proof of stake, it's supposed to increase the scalability of Ethereum and make it actually more accessible for layer 2s to be built on top of Ethereum. Can you just briefly in layman terms explain how this process is supposed to work and how this may or may not impact scalability?
Yeah, I think that's kind of the next step in the Ethereum roadmap, is implementing sharding. And I think that is the pathway to kind of making Ethereum super performant. We had a lot of talk about, previously different layer 1 applications coming in and having, much more throughput or transactions per second than Ethereum. And sharding, what it does is it kind of breaks up that load. So it's not like every validator has to know the history of the network. It's kind of sharded across the network. So all the different validators or all the different nodes that participate have a kind of a shard or piece of that history. Right. And then they can collectively put it together in a much more optimal way than it's currently composed. So overall, it makes Ethereum much more scalable. It makes transactions much faster. And overall just makes it, more of almost an enterprise grade solution where settlement can happen, at a fraction of the time that it happens now.
Okay. Let's talk about the roadmap to mass adoption of Ethereum, which you've discussed in your report extensively. Consider this concept, the concept of hyper-Bitcoinization, which is an idea that in theory, one day we could have Bitcoin be incorporated into every aspect of our everyday life, not just in terms of institutional adoption or trades, but we could use Bitcoin for everything, transactions, medium of exchange, a lot of different things. Extending this concept to Ethereum, could we one day see hyper-Ethereumization, if you can coin such a term? Same concept, could we one day see Ethereum be incorporated into every aspect of not just our life, but also Web3? And what is the roadmap to getting us there?
Yeah, it's a tough question to kind of answer, but I think it comes down to Ethereum functioning as that de facto settlement layer. I would say that, there's so much value locked in the network now that it makes it very difficult to kind of attack it from the outside or even from the inside. It becomes a huge financial burden and almost, it takes a very, very large sum of money to do it. And I think with that said, that kind of enables, it enables trust, right? So if you have a bunch of actors in the space that want to participate in some sort of smart contract, they're more likely to come to Ethereum to do it just because the security is that robust in comparison to other networks. So I would say that overall, it's hard to identify what those use cases are. In my sense, it's as simple as sending and receiving money. It's as simple as, decentralized borrowing and lending, but it's also smart contract execution, everything from, interacting with any protocol you think of to kind of minting NFTs, all those things become possible on Ethereum, not only because of kind of the settlement layer aspect of it, but also because it becomes more performant over time. And I think right now it becomes performant because of a lot of those layer 2 scaling solutions that kind of operate on top of it.
I just want to point out that maybe I'm misinterpreting this. Correct me if my assumptions are incorrect. But just to finish off on the deflationary aspect of Ethereum, could we not, in theory, have a burn rate surpass the issuance rate to such an extent that eventually the supply becomes zero?
I mean, theoretically, I don't know if theoretically that's possible, but I think practically, I don't think that's really a possibility. You would need, trillions and trillions and trillions of transactions to kind of do it. I'm not so sure about that.
Okay, so that's not really a concern. What about the ETH flippening, the idea that the Ethereum market cap could surpass that of Bitcoin? I mean, in theory, again, going back to theory, as an investor, I would like to invest in something that's deflationary rather than something that has a fixed supply. I mean, by theoretical default, Ethereum should have a fixed supply at some point. Right now, we're above 110 million, I think 110 million, 111 million ETH in circulation in supply. That should be coming down over the next couple of years. Why would I invest in Bitcoin if I can invest in this deflationary asset that everybody wants, according to your thesis of adoption?
I mean, I think there's use cases for both, and just from in my view, I think that Ethereum is kind of like the internet computer, where it's kind of the infrastructure where things are being built and transactions and smart contracts are kind of performed. Bitcoin is more of a store of value. It certainly, it has its purpose, it has its functions. But I think that at the end of the day, Ethereum kind of operates as that infrastructure layer that allows, countless decentralized applications and different middleware layers to kind of operate on top of it. And that all comes back to kind of value accrual. The more of these applications that are built, the more of these layers that are kind of built robustly, are going to kind of drive activity. And with more activity, I think that the underlying Ethereum becomes that much more valuable.
Right. Okay. Well, thank you for laying out your case for Ethereum and explaining the merge in great detail. David Shuttleworth, thank you for joining Kitco, and I appreciate your work.
Thank you so much, David. Thanks for having me.
I'll put a link down to the report that you co-authored in the description so people can check it out in greater detail. It's something like 50 pages, so a lot to go over. We didn't have time to go over all 50 pages. Thank you again, and thank you for watching Kitco News. I'm David Lin.